Assalamualaikum warahmatullahi wabarakatuh, and I will present about our project, which is the 7-story office building in Kuala Lumpur. The construction will start in January 2020 and ended in the end of 2020. The total budget of this project is almost 6 million ringgit, with 35% of the fund is from CIMB Bank Berhad and the others is from the equity partner. This building is developed to promote the idea of green building and sustainable building technology, and the goal of this building is to decrease the total effect of the built environment on human health and natural environment across the building. Next is life cycle cost. Life cycle cost, or as known as LCC, is consists of initial investment, that is budget, and the follow-up costs, and sometimes it's also including the demolition costs. In this project, we will focus on 4 elements of LCC, that is design and construction costs, operation costs, maintenance costs, and end-of-life costs.
WBS. WBS is a method of breaking down a big job into a smaller, more manageable part. A large project is managed by first dividing it in WBS into an individual part. The WBS is a framework that defines tasks, facilitates the allocations of resources, assign responsibilities, and measure also control the project. The WBS is usually used by the project management as a planning tool for the project. Establishments of WBS including control, risk, net, assumption, schedule, resources, activity.
Okay, there are several types of works, which is substructures, finishes, superstructures, services, fittings and furnishings, and the last part is external works. Okay, for substructures, we have work below lowest floor plan, which is cost around 90,000 ringgit. Okay, next, for finishes, we have internal wall finishes, internal floor finishes, internal ceiling finishes, and external finishes. And the total cost of finishes was around 4,032,000 ringgit. Okay, next, for the superstructures, there are frame, upper floors, stairs, external walls, windows and external doors, internal walls and partitions, and internal doors. And the total cost for the superstructures was around 200,000 and 300 ringgit. Okay, next, for the services, we have sanitary applications, plumbing installations, refuse disposal, electrical installation, communication installation, and lift installation. And for the total cost of the services was around 591,200 ringgit. Okay, next, for fittings and finishings, the cost for fittings and finishing was around 250,000 ringgit. And for the last part, which is external works, we have site work, drainage, and external services. And the total cost for external works was around 174,500 ringgit. Okay, and the total cost for this construction, which is the construction cost, was around 5,338,000 ringgit. Okay, next, the cost analysis for our project. Okay, the first one is the preliminary cost. The preliminary cost has a value about 15% of the total construction cost. Okay, 15% was multiplied by 5,338,000 ringgit, and the preliminary cost was 800,700 ringgit. Okay, next, the design cost has a value about 9.5% of the total construction cost. Okay, 9.5% was multiplied by 5,338,000 ringgit, and the design cost was 507,110 ringgit. Okay, next, for the construction cost is around 5,338,000 ringgit.
Next is a cash flow diagram. Cash flow is the movement of revenue into an expenditure out of firm or other organization over time. Cash flow is very important for ensuring that the right amount of capital is in a place and that liquid drawdown facilities are available. There are three types of cash flow. First, cash flow from operating activities. Second, cash flow from investing activities. And the last one is cash flow from financing activities. Example of cash flow from operating activities is amortizations of concession asset, revenues, and operating expenses. Example for investing activities is a purchase of property, purchase of plant and machinery, and purchase in investing properties. And last one is financing activities. Example is drawdown of bank borrowing, issuing shares, interest, and last one is interest paid. As you can see here, this is operating activities. For operating activities, it's begin from January 2020 until December 2020. The beginning balance for January until June 2020 is 2.3 million. Then the operating activities total is 154,000. For July until December 2020, the beginning balance start around 1.6 million. Then the total of operating activities is 139,000. Next is investing activities. Total investing activities for January until June is going negative because more money is spent than received. While for July until December is remain positive due to there is money flowing into account which is 47,000. Last one is for financing activities. The total for financing activities from January until December is remain negative and the net cash flow also negative. It is because too much money spent on these activities. So this is our cash flow diagram of construction project. As we can see in the table has three elements which is beginning balance, income and invest. In this cash flow diagram, value income from January until June 2020 which is 2 million is positive cash flow. So the error is going up. Then for value of investment for January until June and July until December is negative cash flow. So the error is going down. And last for the positive value which is 47,000 and 35,350 are respectively gain from resale of property and plant machinery.
This is Izzah binti Basiran. I will be explaining on the project finance of this group project. So the project finance we will be using is the debt and equity funds. So what is this debt and equity funds? So the debt and equity funds are the both source of capital money. So debt is kind of loaning or borrowing money from bank, while equity is represents the shareholder stake in the company. So we go to the debt first. So the company owes to another person or entity or bank, meaning the company needed to pay amount of money to the another person. The second one is loan funds. It's called loan funds because we borrowed the money. And then the third one is in short term, meaning so when the debt fully paid, there is no link anymore with the lenders unless wanted to do another contract. The fourth one is the bank in this case is called lenders or creditors. And then the fifth one, the term called in this debt is loan, debentures, and bonds. Okay. The sixth one is returns in the form of interest. It's called interest, where we have to pay more than what we borrowed. And then the return is fixed and regular in the contract. Okay, so we go to the equity. So the first one is own funds raised in the company by shares, meaning the own funds between the shareholder of the company. So it's called own funds. Is in the long term, as long as the shareholders wanted to have share in the company. And then it is proprietors. The term called shares and stocks. And then the returns between them is called the dividend because it's separated between the shareholders. And then the return is varied and irregular because it's follow their each own shares that they wanted to put into the project. Okay, this is I will be explaining about the calculation of our debt and equity in this our group project. So the project being designed is a 7-story office building at Kuala Lumpur. The total cost of our project building is around 5 million. So with that of having 35% borrowed from CIMB Bank Berhad, and its interest rate is 8% compounded quarterly. The another 65% we decided to sell it to the public and equity partners whom we expect a return on their investment. So from the equity we got around 4 million, while where we borrowed from the bank we got 2 million. So this is the calculation. For is because we compounded quarterly. The interest rate we compounded quarterly. So when we calculated, we got 184,000 plus the amount of we borrowed. So by 2,484,000 is the total amount which we have to pay back to the bank.
CAPM. So CAPM is a tool for estimating the cost of capital for firms and the returns that investors require in investing in a company's asset. Next, it is also used as an application such as estimating the cost of capital for firms and evaluating the performance of managed portfolios. Next is a principal prediction of the model is that the expected return on any two assets is linearly related to the covariance of the return on this asset with the return on the market portfolio. Each asset has two types of risk, which is diversifiable or unique risk and non-diversifiable or market risk. So the formula of CAPM is ER equal to RF, which is stand for risk-free rate, plus beta stand for correlation with the market, in bracket ERM minus risk-free rate, close brackets. For the weighted average cost of capital WACC, the concept of weighted average cost of capital WACC is the total cost of capital for all sources of financing in a business. Weighted average capital expenses are used as widely in commercial enterprise as they are in public enterprises. A company may collect its capital from the three sources, which is cash, debt, and common stock. And the total capital cost is defined as the weighted average for each of the costs. There are some advantages and disadvantages of WACC. The advantages of WACC is that it is simple and easy, single hurdle rate for each project, and prompt decision making. For the disadvantages of WACC is that difficulty in maintaining capital structure and cost of equity is difficult to calculate. It is also important source of capital being avoided. The limitation of weighted average cost of capital WACC, it is assumed that there would be no change in the capital structure, which is not possible of all over the years, and if there is any need to source more fund. Next, it is also assumed that there would be no change in the risk profile. As a result of faulty assumptions, there is a chance of accepting bad project and rejecting good project. Profit of this project is that using 35% of debt, which is 2,300,000, divide by the period of debt, which is 4 years, with 8% of interest, resulting a number of 575,000 value per year. 8% of this value resulting 46,000. So for the value per year, which is 575,000 plus the 46,000 resulting 621,000 ringgit Malaysia, which is the value that need to be paid to the bank every year. So the rent of this project assumed to be 70,000 per month, which is 840,000 per year. So the profit of this project is 290,000.
As a conclusion, this project management framework on the cost and financing of the project can help in promoting green building construction in Malaysia by including the analysis of the project using LCC, WBS and CFD. It is possible to promoting adoption of sustainable management approach for future green building projects. In this project, we know the exact cost of this project. The preliminary cost is 800,700 ringgit, design cost of 507,110 ringgit, and the overall cost is 5 million ringgit. The cash flow of the project be defined by three categories, which is operating activities, investing activities, and financing activities. And the total income for the project is 4 million ringgit above, while the profit that we get from this project is 219,000 ringgit. That's all from us.